The US was quite successful when it put pressure on Saudi Arabia to stop them from joining BRICS. And now the US has been exerting pressure on Saudi Arabia to distance itself from China and Russia. However, Saudi Arabia's sovereign wealth fund signed agreements worth as much as 50 billion US dollars with 6 leading Chinese financial institutions. In the latest example of the kingdom's deepening ties with China, according to a statement from Saudi Arabia's 925 billion US dollars public investment fund, the deals were done to boost two-way capital flows through debt and equity. The MOUs were signed with 6 leading Chinese financial institutions. Saudi Arabia's recent agreement with Chinese financial institutions of 50 billion US dollars worth is a clear inclination towards strengthening ties with China and defying pressure from the United States. Also, the agreement is part of Saudi Arabia's ambitious Vision 2030 plan by Crown Prince Mohammed bin Salman, which aims to diversify its economy away from fossil fuels to develop a vibrant private sector and reduce its reliance on an oil-centric economy. The government of the world's biggest oil exporter hopes its nascent manufacturing industry will one day turn out everything from computer chips to tires in a wider economic transformation. Before I proceed, please consider showing your support by clicking the like button. Your engagement helps to connect with more viewers like you. Thank you for your support and don't forget to share your views on the topic in the comment section below. China said in July it was ready to deepen cooperation in infrastructure, energy resources, green development, and the digital economy, and welcomed Saudi companies such as its sovereign wealth fund and oil giant Aramco to continue to do business in China and facilitate greater economic integration between the two nations. Despite the US concerns, Saudi Arabia increased investment in Chinese markets in 2024 and reached 3 billion US dollars, which was just about 100 million in the previous years. The significantly increased investment from Saudi underscores the growing economic interdependence between Saudi Arabia and China. Bilateral trade between the nations reached to new high of 107.23 billion US dollars in 2023, and the trade relationship has continued to flourish in 2024. The robust growth between Saudi and China underscores their economic partnership with significant cooperation in new areas like technology, space, and manufacturing. China's diplomatic push to court US ally Saudi Arabia comes amid Washington's weaponization of economic policies, nudging it to expand ties with countries in Europe, the Middle East, and Africa. China is seeing a surge in investment from funds in Gulf nations at a time when Western financial firms are reining in investments in the country, deterred by concerns about geopolitical risks. China also recently approved its first exchange-traded funds investing in Saudi Arabia equities. While economic cooperation between China and Saudi Arabia remained anchored on energy interests, ties in trade, investment, and security has been expanding. China is Saudi Arabia's top trading partner. After the 50-year-old petrodollar deal between the US and Saudi Arabia expired, China took advantage and started business in its own currency yuan, with the Saudis potentially challenging the US dollar's dominance in global oil markets. On 20 November 2023, the People's Bank of China and Saudi Arabia's monetary authority signed a currency swap of 6.98 billion US dollars for 3 years to settle trade transactions using their local currencies without converting to US dollars, aimed at reducing dependence on the US dollar. Saudi Arabia is in active talks with Beijing to price some of its oil sales in Chinese yuan, which would dent the US dollar's dominance in the global petroleum market and mark another shift by the world's top crude exporter towards Asia. The move coincides with Saudi Arabia's recent participation as a guest nation at the BRICS Outreach Ministerial meeting in Russia. BRICS is pushing for greater use of local currencies in international trade and financial transactions. The BRICS meeting, held for the first time since the group's expansion in 2023, emphasized the necessity for reforms in international financial institutions, including the IMF and World Bank. The use of financial sanctions as a geopolitical tool by the US is driving these decisions of countries trying to move away from the dollar for global trade settlements. The recent sanctions by the US and its Western allies of Russia to isolate it from the global financial system are a significant reason as other countries worry about similar consequences in the future. While Russia has managed to trade and expand outside the dollar-dominated markets, the sanctions have weighed on its exports and imports. According to a poll by the UBS Group, central bank reserve managers are increasingly worried about the safety of their foreign currency holdings. The poll respondents attributed this rising worry to the rising global geopolitical risk. The weaponization of foreign exchange reserves was deemed a high risk by one-third of the participants, double the number from the previous year. For 87% of the 40 central banks polled by UBS, the situation in West Asia, increasing tensions between China and the US, and the ongoing war between Russia and Ukraine were the top concerns, with the risk that if hostilities intensify, central banks could face sanctions, seizures, or asset tapping. The viability of forex reserves as a viable option is being questioned. The proposal to use Russia's $300 billion frozen foreign currency assets to aid in Ukraine's reconstruction endangers the usefulness of forex reserves, the safest and most liquid way for a nation to hold its money till now. If these worries cause people to flee dollar-dominated assets, the dominance of the US currency could be further challenged. Global central banks, which manage the world's foreign exchange reserves, hold an average dollar amount of 55% in their import war chest. That proportion has steadily declined from 67% in 2021. About 8% of the central banks increased their yen holdings, and 25% increased their euro allocations in an attempt to diversify away from the dollar in their forex reserves. As geopolitical risks rise, central banks are also increasing their gold reserves. As much as political forces will use currency reserves as a weapon, the dollar will suffer as a result. Saudi Arabia's move towards China to guard its economic interests will encourage more countries to save their economic interests from the current risky geopolitics. Thank you for watching, and don't forget to subscribe to our channel for new videos on important international topics.